focus on CPI inflation. Central banks either were given or they chose a very narrow definition of inflation in terms of the CPI, and they disregarded what was happening in financial markets. So we have this, for example, this situation in the Eurozone where M3, which is the broad measure of monetary growth, grew up to 12%, which is quite a lot, I can tell you. And at the same time, CPI inflation was quite modest, around 2.5%. So the central bank claimed at the time that it was doing its job. So is there something we could do now to remedy this flaw, in my view?
Well, shall I pick this up? Yeah. This is really one of the important things for looking at quantitative money. Milton Friedman warned about long and variable lags between movements in money, and in the early 70s we had in the UK 20-25% growth of broad money, and actually inflation was still less than 10%, and house prices, stock market was soaring. Okay. Same kind of story in a larger, more dramatic way than in the Eurozone in 2006 and 2007. Then the inflation in price in shops and goods in shops and so on came through in 74 and 75. And we had the same kind of pattern in the Eurozone emerging in 2007, 2008. Basically, the initial effects of the monetary upsurge up to double-digit rates was in asset prices, strong economy, then inflation started to come through, and in 2007 they started to, and indeed you remember they actually had that rather crazy interest rate rise because they thought they were right about inflation. So there are a lot of lags. You need a history. You need to remember what's happened in past cycles. And but can I just say, Juan, if you're suggesting we should look at asset prices as well and set central banks' target for asset prices, no, I don't agree with that. No, I think that as long as what's very important is the central banks to have a medium or long-term perspective in which money and banking are absolutely central. Okay, and can I just say again, coming up to 2007, so it's taken such a long time, the models that were being used in the central banks were just dreadful, just dreadful. There was this three-equation new Keynesian stuff. It just failed hopelessly. No, you must always look at what's going on inside the banking system, looking at the rate of monetary growth. Always.
Just to clarify my point, I didn't mean to support an asset price inflation target. I wouldn't do that. That's too messy. I wouldn't advise any central bank to do that. But just to focus on a much broader definition of inflation in terms of money growth, to be honest. Mm-hmm. But sorry, Geoffrey. I don't know if you have something to say.
Very briefly, we should remember why inflation targeting was brought in. It was brought in, as Tim emphasised, really, to give central banks a longer-term perspective. It was also brought in, the first central bank to introduce it in the modern era was the Reserve Bank of New Zealand. They introduced it deliberately, the politicians introduced it deliberately, as a way of tying their own, the politicians' hands, to ensure there was a long-term focus which everyone was signed up to. Once you have this long-term focus, it actually doesn't matter very much what it is, so long as you stick to a long-term focus and adjust policy as best you can in expectation of what's coming in future. Looking at asset prices can be misleading, it can be informative. When we talk about the transmission mechanism of monetary policy, from a shock provided by central bank money to the economy more generally, asset prices can be a very important part of the story. But the transmission mechanism is really a second-order question when we're thinking about the long-term objective of price stability.
Okay, thank you. So shall we open a time for questions from the floor, please? So anybody? Please. Do you want to use the microphone?